Things have started to change in Canada in a big way, and it could have some major impacts for every Canadian. You see, there's one key indicator that has switched directions recently that I don't hear anybody talking about, and this indicator is tightly tied to how much money Canadians make, how well Canadian businesses do, how Canadians' investments perform, and even how much money the government could be willing to spend. So let's get right into it and make sure to subscribe to the channel if you haven't already done so, and stick around to the end where there's an opportunity that you might actually be able to work alongside this channel. We'll get into that in a second. Now this all has to do with the Bank of Canada, Canada's central bank, which is responsible for making decisions that impact Canada's monetary policy. We'll come back to this chart which shows some of the assets that the Bank of Canada owns and how that impacts Canada, but before we do, we have to talk about the unique situation that Canada finds itself in and how it could be prompting the change that we're seeing in this chart. Right now, Canada's economy, and you might not need me to tell you this, isn't doing all that well, with our GDP largely stalling, our gross domestic product. This is the number that many politicians look at to say, hey, look how well our economy is doing, and make themselves look good, right? This GDP stall is happening all at the same time that we're seeing a huge boom in population, which would traditionally help the GDP quite a lot, right? As we add more consumers to the economy, more workers to the economy, and more demand to the economy. Now, we've talked a lot on the channel before about how this is kind of like a sort of human stimulus for the economy, helps make things look better than they actually are, while the average GDP per person stalls and even declines as of recently. But there is one other previously unsaid benefit of these high immigration targets, and it's for large big box employers and big business chains who otherwise would have been struggling to find employees. Now, this is something that hasn't really largely been said. It doesn't sound all that great, but it's something that now the Liberal immigration minister is being kind of forthright about.
You mentioned aligning international student numbers better with, I think you said, demand. What does that look like? And is that demand from the institutions? Because we've seen they've increased it threefold over the last decade, so they certainly see the demand, or is that demand from industry in terms of having those international students work in Canada?
Yeah, I mean, look, there's a lot of conversations with different competing policy priorities. You have industries and low-skilled labor, whether it's big box shops or others, looking for cheap labor and wanting to make sure that they maintain a 40-hour work week for some of the students. That's the competing policy with the labor gap that we face in this country, and we need those people working. And why not, if they're paying a whole heck of a lot of money to come to Canada to study more than a domestic student, why would we deny them that right? So some competing issues there that we need to really tackle with.
This does seem a little bit exploitative to me, selling this sort of positive life in Canada, but really you're just trying to bring people into the country to satisfy big business so that they don't have to increase wages for people who are working at their stores. Now, this all impacts Canadian growth, and alongside it, you and your money, and we'll get into that in just a second, but it seems like this human stimulus pipeline might be sort of drying up here. Take a look at this. We've got the number of Indian students applying to study in Canada dropping by 41%. This article from January 8th, 2024. This could be for a number of reasons, right? Of course, we have the tense India-Canada relationships over Canada alleging that the Indian government was involved with the murder of a person on Canadian soil. I made a video about that a little while ago, but it could be not that. It could just be people realizing that, hey, maybe they're being exploited, paying double, triple tuition to come study here, and that the land of milk and honey that university recruiters are selling them may not be all that they seem. So it seems like the human stimulus pool could dry up. And what would the GDP growth that politicians watch so closely and pat themselves on the back for, what would that look like without this added labor supply and without this added consumer demand? Well, we might be about to find out. And without growing the economy by adding workers to the economy, the only other way that we can grow the economy, and as a result the quality of life for Canadians, is to increase our productivity, the average amount that each Canadian makes and contributes productively to the economy. That's like our GDP per person or GDP per capita, something Canada has historically been bad at, and something we talk about on the channel quite a lot. And it's something that it looks like Canada is not going to get a lot better at least in the short term here. The OECD, which is a large group of countries internationally that sort of compare their economies to get learnings from that comparison, well, they say that, okay, Canada isn't looking so good leading up till 2020 or 2030 in terms of their GDP per capita forecast. We see all of these other countries sort of coming in here at 3.1% per year of growth in GDP per capita, and the projections here for Canada, right at the bottom of the list, around 0.7% growth in that GDP per person, or growth in the quality of life in Canada. And recent numbers, this data is a little old, recent numbers are showing that it's actually a little bit lower than that even. With all this put together, the prospects of growth in Canada aren't looking too good, right? And that leads me back to the chart we started with from the Bank of Canada. And once we take a look at this, you're going to have a better idea of how all of this could wind up impacting you. I'm going to move myself over here so that you can see things a little bit more clearly. One thing that's definitely slowing growth in Canada is where interest rates currently are, right? While if you look back at the 70s and the 80s, rates aren't too high right now, sitting around 5% for the Bank of Canada's overnight rate. But when we're taking into consideration the low for long policy that's been in place since 2008, well, the rates we're seeing today are quite high in relation to at least that period. And these higher rates have all kinds of impacts on the economy. It impacts businesses because they can't expand as quickly, can't take on cheap debt in order to expand their businesses. As a result, investments don't perform quite as well. It affects the real estate market with higher interest rates. Of course, people can qualify for less, and as a result, real estate prices have come down a little bit due to these increased rates. And Canadians just in general feel poorer, and this is kind of the point of increasing the interest rates. The Bank of Canada, of course, trying to avoid more inflation by making Canadians feel poorer and as a result spend less money. And who controls interest rates? Well, it's the Bank of Canada, right? They can control interest rates in two different ways. The first one is by changing their policy rate, just the rate that they set their overnight rate at. And the second one is through quantitative easing or quantitative tightening. This has to do with the Government of Canada bond market. You see, interest rates that we all experience in the economy are largely tied to these Bank of Canada government bond rates. Right? If we have a higher yield on these bonds, that will result in a higher interest rate that most Canadians experience throughout the economy. Now, the unique thing about bonds, and we won't get too deep into this, is that as the price of a bond increases and the demand for the bond increases, the yield of those bonds or the rate attached to them decreases. We're not going to get into why, but that's how it works. Bond price up, yields down, bond price down, yields or interest rates go up. So the Bank of Canada can control where interest rates go by purchasing or selling Government of Canada bonds, and as a result, either raising or lowering the price from their added demand or their added sell pressure. That's exactly what they did in 2020 during the pandemic to stimulate the economy. We had interest rates already at their lows, at least from the Bank of Canada's policy rate perspective, but they wanted to stimulate the economy even more than that, so they printed a bunch of money to buy Government of Canada bonds to increase demand for those bonds, increase the price of those bonds, but simultaneously lower interest rates as a result of that increased bond demand. Then you know what happens here. We saw this incredibly high period of inflation as a result largely of this quantitative easing or this mass Government of Canada bond purchasing program. To combat that inflation, not only did the Bank of Canada raise interest rates aggressively, extremely aggressively, like we've talked about already, well, they also flipped from doing quantitative easing to quantitative tightening, which is just no longer purchasing Government of Canada bonds, no longer adding this artificial bond demand to the market. As a result, we see the Bank of Canada, and shown on this graph, their balance sheet in the amount of Government of Canada bonds that they own, significantly decreasing as they sort of let this roll off of their books when each of those bonds reach their maturity. They just don't purchase new bonds with the funds that they receive from those bonds maturing. But that's where I think things are finally starting to change, because we've seen the government of Canada, or the Bank of Canada rather, letting these bonds roll off as a result of quantitative tightening. But now we see a sort of pause here in the decline of the amount of government of Canada bonds the Bank of Canada owns. While this is still clearly on a downtrend, I think that this period between September and now into the new year, December 27th was the last reading, we're seeing like a pause here in the decline of the Government of Canada bonds on the Bank of Canada's balance sheet, and even a period of multiple weeks in a row where, okay, these assets on their balance sheet are increasing, meaning that they kind of are trying to say, hey, market, I want rates to come down a little bit, even if I'm not going to signal that to the broader market through saying we're going to cut rates. I think that this is a precursor to a pivot in terms of the Bank of Canada's direction from tightening or making Canadians feel a little poorer to sort of slow down spending in the economy, to easing, making them feel more willing to go out and spend money. And I think it could be tied to the negative outlooks for the economic growth in Canada that we covered early. Now, some would also say that this is leading into an election, and having economic growth is helpful for the current government, but of course the Bank of Canada and the government claim to be fully separate and independent. So if I'm right in thinking that the Bank of Canada has already pivoted, even though they are not publicly saying that, as indicated by this pause of quantitative tightening, well, a lot of different things could happen. What does this mean for you? Well, if we do see lower interest rates in the Bank of Canada cutting, well, we could see an increase in asset values as people can borrow and borrow more easily and for more cheaply, and as businesses can grow and expand more easily. That's going to increase the value of the stocks for these companies. It also means relief for mortgage holders, which who are trying to renew their mortgages right now. They'll be able to renew at a slightly lower rate, and that could result in fewer sellers hitting the market. Also, just could prop up real estate prices, as these potentially lower rates coming in the future could allow people to borrow more, afford more, and be able to offer more on these properties. But lowering rates doesn't come without their risks. I think that it does increase the risk of us seeing inflation to a higher degree than we are right now. We've got it back down to around just over 3%, 3.5%, 4% is where we've been hovering over the past number of months. The Bank of Canada wants that to be between 1% and 3%, but if we cut rates, there's a chance that inflation could come back up. And if that happens, there's the potential for stagflation, where we use lower rates to boost spending and stimulate the economy, but as a result, we increase inflation. And if we don't see that increased spending translate into increased GDP growth, well, then that's the recipe for stagflation, right? Inflation at the same time as the GDP stagnates. But the number one thing that I think that this will do, and I think it is a larger trend, a 20, 30, 40-year trend, is we're going to see a larger divide between asset holders and cash holders, right? What do the wealthy people in our society hold and own, right? They own businesses through stocks and equity, they own real estate, they own these things that have sort of a harder value than the value that they're tied to in terms of cash. Right? If we see lower interest rates, and potentially even if there is some sort of event where the Bank of Canada needs to stimulate more money printing, more quantitative easing, well, these assets tend to increase in value, while the relative value of the cash that a lot of average Canadians hold diminishes, right? That's why I think we're seeing this hollowing out of the middle class, with the wealthy getting wealthier and wealthier, and the poor getting poorer and poorer relatively. This is at least how I see things based off of all the information that I've been reading and the way that I'm thinking about things. I'm curious if you think I've gotten things right here, or if I've gotten things totally wrong. Both are okay. We're just trying to figure things out here on the channel. Let me know down in the comments what you think. But now I want to talk about something that's a little bit different and we haven't done on the channel before, and it's an opportunity for us to sort of work together in a way. You'll have no doubt seen the rise of short form content on platforms like YouTube Reels, those shorts, Instagram Reels, and TikTok. It's something that I haven't really dove into very heavily on this channel. Some of the messages that I'm putting out here on this channel, I think, deserve to go to broader audiences, even if I don't have the time to touch on that and do that work to make those shorts. So I'm putting out an open call here. If anybody wants to use the content from these videos to cut it up and make it into YouTube Shorts or a TikTok and use it on TikTok, then by all means, go and do that. I'm not going to copyright claim you. Any revenue that you make from repurposing this content for short form, that is yours to keep. And at the end of the month, the video that has the most views using this content, I'm going to reach out to give a $100 prize. So if anyone wants to use this content, make a little bit of revenue on your own, I'd ask that you go ahead and do that, and just use a link to this channel and reference sort of Russell Matthews in some way. There'll be more details in the description of this video for all of this. So check that out if it's something that sounds like it's interesting to you. But with all that said, thanks so much for watching this video. I hope it helped you out at least a little bit, and I'll see you next time.